You know, we hand our money over to banks every single day, but have you ever stopped to think about what their actual job is? I mean, is it to make our money grow, or is it just to keep it safe? Today, we're going to dive right into that fundamental conflict that sits at the very heart of every bank, using a fantastic guide on asset and liability management to sort it all out.
Okay, so let's just boil it all down. What is the one thing a bank is really supposed to do? Is it just a vault to keep our savings safe? Or is it something more, like an engine for the economy, funding everything from startups to your neighbor's new house? Well, the reality is, it's this constant fight between those two ideas.
Yeah, every single bank is walking this incredibly thin high wire. On one side, you've got this immense pressure to make money, to create value for their owners. But on the other side, well, they're holding our money. And that means they have to be super careful. They have to control risk. So it's always profit versus prudence. And these two are always pulling in opposite directions.
Our source material for this has an analogy that is just perfect. It says a bank strategy is like the Tour de France. You got to pedal fast enough to win the race, but you also have to be careful enough not to wipe out on a tight corner. I mean, that just nails it, right? It's this high-stakes race. So, okay, let's talk about the pedaling fast part first.
All right, so let's dig into that winning the race side of things, the profit side. When you get right down to it, any bank that's traded on the stock market has one single primary goal: make its shareholders money, create value for them.
Okay, so how do you actually measure that? Like, how do you know if they're doing a good job? Well, there's this one number that every single banker is obsessed with. It's called return on equity, or ROE. Think of it like their final grade. All it is the bank's profit divided by the money the shareholders put in. It's asking a really simple question. For every single dollar our owners invested, how much profit did we spit out?
But, a number like a 15% ROE is kind of meaningless on its own. You have to compare it to something. And that something is called the cost of equity, or COE. Think of it this way. If you're an investor, you could put your money in something super safe like a government bond and get a guaranteed return. That's the risk-free rate. To convince you to invest in a much riskier bank stock, the bank has to promise you at least that safe return plus a bonus for the extra risk you're taking. That total, the safe rate plus the risk bonus, is the cost of equity. It's the minimum grade the bank has to get to pass the investor's exam.
And this, right here, this is the golden rule of modern banking. It's incredibly simple. If your return on equity is higher than your cost of equity, you're creating value. Everyone's happy. But if your ROE is lower than the COE, you are actively destroying the value of your owner's investment. It is that black and white. It's brutal.
Okay, so here's where it gets really, really interesting. How does this big, abstract, golden rule actually trickle down and affect you and me? Like, how does it end up deciding the interest rate on a loan?
I mean, it sounds crazy, doesn't it? How can some shareholder somewhere demanding a certain return on their investment actually change the numbers on your car loan application? Well, believe it or not, the line between those two things is surprisingly short.
So let's walk through it. Imagine a simple $100 loan. The bank doesn't just pull that $100 out of thin air. They go out and borrow most of it, say $92 from places like our savings accounts. But, and this is the really important part, a chunk of that loan, maybe $8, has to come directly from the shareholders' pockets, from their equity. That's their skin in the game. It's the bank's own safety buffer.
Now, because that $8 of shareholder money is on the line, the bank can't just charge enough interest to pay for the $92 it borrowed. No way. They have to tack on an extra little bit, an extra margin. It's called the equity spread. And that tiny extra piece of interest exists for one reason and one reason only: to make a profit on that $8, a profit that's big enough to keep those shareholders happy and meet that golden rule.
So, you see, it all comes back to that simple formula. That little bit extra you pay on a loan is directly tied to the bank's need to keep its ROE higher than its COE. But wait a minute, this raises a really obvious question, doesn't it? If putting in less of your own money, using more leverage, makes your ROE go through the roof, then why not just go crazy with it, right? Why not fund that $100 loan with just $1 of equity and $99 of debt? The returns would be astronomical. But that is where the don't crash the bike part of our Tour de France analogy kicks in. So now let's flip the coin and look at the other side, prudence. Okay, so what stops a bank from just taking on insane amounts of risk? Well, the biggest set of brakes doesn't actually come from inside the bank. It comes from global regulators. Think of them as the financial world's highway patrol, setting a very strict speed limit.
And after a lot of debate, these global regulators all agreed on one magic number: 8%. That's it.
This became the absolute minimum capital a bank has to hold, a rule cooked up by the Bank for International Settlements, or BIS. So, what on earth does this 8% rule actually do?
Basically, the rule says that a bank's capital, its own money, that safety cushion, has to be at least 8% of its assets. But here's the really smart part. It's not 8% of its total assets, it's 8% of its risk-weighted assets. This forces banks to not just look at how much they're lending, but how risky those loans are.
And this is how that risk weighting works in the real world. Regulators basically assign a danger level to everything a bank owns. So, a super safe government bond, that gets a risk weight of 0%. The bank doesn't need to hold any extra capital against it. But a loan to a regular company, that's seen as riskier, so it gets a 100% risk weight. That means the bank has to hold the full 8% capital cushion against it. The logic is simple. The more dangerous the asset, the bigger the pillow you need to cushion the fall.
And just to add another layer, regulators also say that not all capital is the same. They split it into tiers. Tier 1 is the good stuff, the A team. It's pure shareholder money and profits the bank has saved up. Then there's Tier 2, which is more like the backup team. It can help, but it's not as strong. And you can bet that it's that core Tier 1 capital that the regulators are watching like a hawk.
So, following those big global rules is one thing, but banks also have to manage their own risks, day in and day out. They have to be constantly looking at the horizon, watching for any financial storm clouds gathering.
And for the average bank, what do you think is the biggest risk they face every day? It's not some Hollywood-style bank heist. Nope. For their bread-and-butter business of taking deposits and making loans, what they call the banking book, the scariest thing is something that happens all the time, a sudden jump or fall in interest rates.
So how do they keep an eye on this? They use something called a repricing gap. I know it sounds super technical, but the idea is actually pretty simple. It's all about timing. Just picture two big piles of money. One pile is all the loans where the interest rate is going to change soon. The other pile is all the savings accounts where the interest rate is also going to change soon. The gap is just the difference in size between those two piles.
Okay, look at this chart. It's a perfect example. This bank has $600 million in deposits, where the interest rate is going to change in the next 3 months, but they only have $290 million in loans getting a new rate in that same time. This is what's known as a negative gap, and it's a really precarious position. It means their expenses are way more sensitive to interest rate changes than their income is.
So what's the big deal? Well, imagine the Fed suddenly jacks up interest rates. The amount this bank has to pay out on that $600 million in deposits will skyrocket, like overnight. But the money they're earning on their loans, that's going to adjust much more slowly. And that mismatch, that can completely wipe out their profits. Which brings us right back to that high wire act we talked about at the beginning, this constant push and pull. So when you ask what a bank's real job is it to go out there and create wealth, or is it to stay home and protect it? The answer is it has to do both every single second of every single day. And if you can understand that constant, delicate balancing act, you're a long way towards understanding how our whole financial world really works.